Yeah, I'm sorry, just because we have a technical problem with the online sessions. This is why we keep you a little bit waiting. Yeah, you're still on time if you want to. Thank you.
Oriane, you're not allowed to ask questions. So Jane, I'm sure it's a question. I'm sure it's a question for Darius. Or you just shout and I repeat the question if you wish.
I think I personally it's kind of much more discussion have this.
Morning.
Oh yeah. So this is that's Frédéric Vonner's view. Huh? It's not Bill Lucy statement. What I truly believe is that we, being asset managers in the liquid space, private market space, and how credit institutions for the time being with MiFID have been addressing or required to address ESG matters, will not be enough. I think it just, I was about to say one drop in the in all the actions and in all the the actions that could and must be taken in order to have an impact. The way we look at ESG and the way asset managers look at ESG for the time being, when there is exclusion, integration, best in class, blah blah. I agree with you. This is not necessarily what brings an impact. And I think the point in Texas with Blackstone, for example, also over there, is a very, very fair one. So my gut feeling is that if we're just looking at the financial sector, it will not suffice in order to have a proper transition and to have the right impact on our lives, because that's at the end of the day what we want to achieve. Yet at the same time, I still believe that it is up to each and every one of us as individuals, as consumers, as investors also, to raise our voice and to change the way we do things, the way we behave, the way we consume, the way we invest. I think we should not wait for someone sitting in an asset management investment committee to decide on promoting a female at boards, for example, because it will help ticking the box of diversity criteria in whatever indicator that you might have in the pre-contract template and ongoing reporting template from SFDR. I think it's up to us to be educated and to make our own view of how we want to shape our future and the future of the future generations. So just looking at asset managers, just looking at credit institutions in the scope of MiFID, I'm insisting here on in the scope of MiFID, is obviously not enough. To your point, Jane, on the impact, we still have, for the time being, only a few limited number of funds, in my view, that are truly impact funds, where the actions taken by the asset managers are having a tangible effect on somebody's life. Again, we cannot change an entire system from one day to the other. Over the last 20, 30, 40 years, asset management has been based on a certain number of principles, a certain number of way of doing things, investing, where ESG might have been present, yes or no. At the same time, I think we have to be cautious of saying, everything that has been done in the past has been wrong. I was discussing, and that's the example I was giving to one of you in the past. I'm working with a French asset manager managing UCITS, and they've been managing UCITS applying sustainable responsible investment principles for decades. So there is something that has been done by that asset manager to try to put forward certain level of ESG topics. And when they were checking the alignment of the portfolio with taxonomy, they ended up with 3 to 6% of the UCITS portfolio being aligned with taxonomy. Does it mean that what they've done in the past was bad? I don't know. Does it mean that taxonomy is going too far? I don't know. Does it mean that they should stop completely doing anything? I don't believe so. So I think it's we are very much in a transition phase now, where asset managers are taking up that the importance of the choice that they do. Yet to your point, Jane, yes, I still believe that the number of and the amount of real impact that the financial sector is doing on the day-to-day life is still small for the time being. Darius, do you want to say something? Isabel? I'm happy to be challenged on that.
Just two quick points on that. Number one, if you are looking at what is happening, yeah, we all agree. Article 8, Article 9, what is the impact to your question, number one? Think about it like this. When a child is born, okay, he falls, he has diseases, till he grows up, till he becomes an adult. That's a process, okay? We have kicked off the process in Europe, okay? The regulators want to channel the capital towards a better future, okay? We are at the start of it. You look at MiFID, you look at all those regulations, the criticisms that were there, everything. Close your eyes and think about 10 years from now. 10 years from now, the discussions will be different, right? That's why I was talking about it's a value shift. It's not an investment shift. Now, we might be impatient, but the train has left the station. It only needs to get speed, okay? To your point around taxes, yes, it's a value shift. And you will have people who are having that discussions. Yes, it is every time when we have seen in the past, the pain of growing up is very harsh, yeah? When our children get diseases, they lie with fever, they are down, they don't want to get their medicine, but still, they have to get their medicine to grow up, yeah? So I'm not discussing about politics, but I just want to give that anecdote. Yes, there will be resistance. Don't go out of it that there won't be resistance, yeah? There will be resistance also in the developing worlds, yeah? They have other issues, okay? So ESG is not on the top of their agenda. So we have to help them through that transition. It is our job as asset managers to have that transition, help those companies to transit towards a better world.
Thank you, Frédéric and Darius. So, apologize for the for keeping you waiting. We had an issue with a technical issue to connecting our next speaker who is attending online. So I'm pleased to introduce the next session hosted by Union Investment Luxembourg, entitled ESG Investing 2.0 Challenges and Solutions for Investors. And for that, I'm pleased we have with us today online Katia Filzek. Katia is Senior ESG Strategist at Union Investment Luxembourg. She joined from Dutch Bank, where she was Director in Company Research in the Global Markets Division. Katia, the floor is yours.
Thank you very much, and good morning also from my side. I will be today a little bit the voice in the off, but I hope that's fine for you as well. Nonetheless, I would be very happy after my brief presentation if you have questions and we could keep that a little bit active as well, like you just had with the other former speaker for the other presentations. Yeah, so let me maybe start with you first with the agenda on the next slide. So what I want to discuss here briefly with you today are three main points. So first of all, yeah, we all face challenges. I want to describe a little bit the majors. Then I would like to introduce to you two of some of our solutions we have to hopefully get around these challenges and yeah, to keep ourselves on track to be in the same picture with the train who left the station. Yeah, how do we want to keep on track? And I have today with me two solutions from our side. The one is, yeah, decarbonization. Why is this getting more important and how can we measure that? And what is there our approach? And then secondly, yeah, that transformation is very important and how we can tackle here issues we have when there are hard to abate sectors involved as well. On the next slide, let's maybe start first of all with challenges. And maybe we can skip already to the next slide. Yeah, I mean, we all know that we already were situated in an energy trilemma. This has even become more fierce and more challenging after February of this year with the invasion of the Ukraine. And yeah, just to show you the 3 points, maybe you can just jump on 3, 1, 2, 3. Thank you. Yeah, so we do have an issue with energy security. This is a major topic going now into winter. Winter is coming. Then also now on the top agenda of most politicians, we do have the energy cost problem, especially in Europe. You might be aware that we have already seen gas prices tenfolding, and on the electricity side, we are between 2 times and maybe even 5 times when you look at the spot markets. Also there, this is clearly now very as a top priority of many politicians, but we should not forget, and this is our focus as of today, yeah, the sustainability of our energy and what we can do to actually accelerate the whole transformation process, and how can we now accelerate also our alternative energies with wind and solar and other renewable sources that we can hopefully then also solve again the security and hopefully the cost issues in the mid to long term. So that's now clearly on our agenda and in most of our minds going into next year. Also, when you now would like to go on the next slide, there are the challenges that if we want to accelerate the expansion of renewable energy, and if we also want to be in line with the scenarios of the International Energy Agency, here you can see on the left-hand side where we have just put in what is the requirement to achieve the just let's say mid-ambitional sustainable development scenario of the agency, and what we need for the net zero alignment in their scenarios. And here we just put in here a view on what kind of metals, so what is the prerequisite of achieving our transition into a more renewable and sustainable future. And here you can see, if you just look on the scenarios, that there are huge amounts of metals to be involved to actually, yeah, be able to transition our systems. And on the right hand side, you might be also aware that we do have, as a sustainable asset manager base, we do have a lot of issues when it comes to cobalt, which mainly sits in Africa and Indonesia. Now thinking here clearly about our exclusions we have in place, but then also nickel. You are also aware that nickel is mainly coming in Europe from Russia. So also this is clearly something we have to deal with. And clearly when you think about rare earth material, yeah, we all have China in our minds, where currently the tensions are also going up. And with the Congress we now see happening in China, this is also something to keep in mind. And what is therefore here also a challenge, what we need to keep in our thinking are these hard to abate sectors like the metal and mining industry, which are very important to achieve all our targets, but also the chemical industry, which is processing all these materials to then the products we all want to invest in and to have ultimately. And if you now want to go on the next slide, then clearly for us as a financial industry or as a asset manager, yeah, you can see that we started a while ago just with data and reporting things. If you continue now with the next, thank you, we then continued with our stewardship initiatives. So over the time, we then finished with COP26 and 21, where, yeah, actually from this data collection and from strategy and targets assessments and commitments. If you want to go one further, we now landed in our last COP26 conference. Yeah, and there we are at our net zero asset manager initiatives. Yeah, and the fact that the regulators wants us to come up with regulated, highly regulated investment products, and also with targets and clear, yeah, let's say also performance indicators and proof of concept so that we deliver on the transformation and we show everybody that we are on the path of transition the companies in which we invest in, but also transition our portfolios. And this is now, let's say, the recent developments, and this is now the challenge we all face. So how shall we now get numbers and data for our physical risks, but also how Paris aligned are our funds and how can we manage all this? And this is now the new target we face. And for this, on the next slide, I would now come up with yeah, the summary a little bit, what we know already. You mentioned that before also on the panel. We all know these ESG Investing 1.0, which is mainly, yeah, the integration part, but also a lot of engagement and exclusions and some of the backward-looking ESG ratings assessments. But now, one please forward. Now we have to develop that further onto the next step, which is, we call it ESG Investing 2.0. And for that, we think a very important element will be the transformation, the inclusion, therefore, also for the hard of abate sectors, and also how do we tackle the decarbonization targets and, yeah, requirements we face from regulation. And yeah, on the next slide now, let's come to our solutions that we offer. Here you can see now we just put in our major, in Germany, our major biggest pollution companies with the biggest carbon footprints. And if you would go one further, you can see how did they perform in the past 5 years. Here you can see, yes, wow, looking at their scopes 1 and 2, there were quite successful developments of some of our most polluters in Germany. Just to mention RWE, but also clearly E.ON. Here you are aware there's an element of M&A activity, but nonetheless also underlying they had clearly they advanced forward. And also when you look at the bottom, there are some chemical companies also there. The development is already there and they are on the path. And that's what we like to see more in our portfolios. And if you would now go on the next slide, please. You can see here also we measures, or we try to measure when we look at our credit portfolios, is there a connection between the spreads or the premiums and the discounts when you are a better ESG rated company that you can see on the left hand side. And here you can see when you look on ESG scores that there is already a correlation. So companies with a bigger or a higher, a better ESG score, they are more expensive. So they are actually, there's already priced in that the investors prefer them over the ones with the lower ESG scores. However, on the right-hand side, if we measure that now against the CO2 intensity of the companies, you can actually see, yeah, you see nothing. So there's no correlation. So the market is not yet in the position or find a way to, yeah, value companies according to their CO2 intensity. So it's very difficult for the market. So that's why you can still see high emitters which are trading with lower credit spreads and some are trading with higher credit spreads. So there's not yet a good price mechanisms in place. But we believe going forward now that this will change. So we believe that in the future, companies with a high CO2 intensity will have to refinance themselves at higher cost, because that's clearly also the target of our regulation. So, and that's why we believe this will change. And now the question is how we can measure that or how we can find out who will be there benefiting and who might be not. And for this, on the next slide, yeah, you can also see, so what can we do to find out, yeah, where are the winners of the decarbonization pathways? And here you can see that we know already there are a lot of analysis and reporting tools, and on the right hand side in green, they are the tools we use as an asset manager to, yeah, scope with that. So we can go for divestment, which is always also for us the last solution, but then there are also optimization tools like best in class approaches, and there's also a lot of engagement going on, and we can try also to find ways of let's say investing more into the low carbon themes, so more a thematic approach as well. However, all these tools do have, as you are all aware, a lot of data challenges. Yeah, we have quality issues. We do have very high difference between sectors. So some are pretty advanced in their reporting when it also came to scope 3, but other sectors are not, or just saying it's simply not possible for us. But then there's also a tilt towards smaller mid caps and large caps, which is not fair in many ways. And then last but not least, there's also the challenge that the regions are developing with different, path and also speeds. So when you think about Europe, which is already very advanced, and you would compare that to Asia or even the United States, you also do have issues here as well. So how do we tackle that? On the next slide, I would now like to present what we developed. So we had a quant-based forecasting tool which we developed, and we based that on the left-hand side on historic data of companies' CO2 emissions. Then also we include in that tool the goals of the companies. So what are their targets, and which points in time they have updated them or reduced them or even increased them. Then we also have a sector and regional view implemented in this tool. And out of this, we then derive a lot of KPIs, which is then hopefully telling us where are these companies developing. And yes, you can see here as well, we have already more than 1,000 companies included in that database, and this is growing day by day. And on the right-hand side, you can see how we come then out with what are the outcomes of this tool. And this is the one visual outcome. So this is an example of one company. There you can see we put in their pathways from the historical achievements, and then we forecast them until 2030 at least, where you then get certain ways. So how realistically is this way, and how is this company developing? This is derived then as a forecasting tool. And you can always see then with every year where you get the reported data, are they on track? Are they outbreaking? Are they better or worse? And then we can also adjust our engagement accordingly. And on the next slide, if you could go one further, you can also see that's another outcome we have then in our system. So all these blocks you can see here, like with the 82% in green, this is every individual company. So that's a company which is very, very well on track of achieving their goals. And then below there are others which are not on track. And this is every year changing, every month with every report we get. And then we can always measure and see, are they performing or are they not performing according to their targets? And this then will not only steer our engagement initiatives, but that will then also ultimately decide what we have in our funds and what not. And we also believe we have to learn and train the system already now and for a lot of years, because when the data then gets better, and it's getting better hopefully year by year, also for regions like the US, then the system will advance further. And our target is also clearly to include here much more companies, to have here a sound picture, and to include much more companies and ambitions as well. And if you would go on the next slide, I would now want to finish up with another solution we have. This is transformation. This is just quickly. We had so far this light blue element in our systems. That's the, let's say, so far approach. This is mainly based, like you know it from ESG integration. It's based on scores and then also a lot of research. The problem, however, was that we're standing there and we do not really have a tool of looking in the future. And with our transformation rating and our transformation approach, we want to get into this green side of the picture on the right-hand side. And this is set up in a way that we have for every sector, we have targets and we have KPIs. And in a minute, I will show you an example from our from one sector. But the idea is really that we can tackle every sector on individual KPIs, and we do that in an approach with sector trios. So we're including here not only an ESG analyst like me, we're including here also a fixed income analyst and an equity analyst. So always 3 people in the board, and then we develop for every sector KPIs. And here on the slide, you can see in the example of an automotive, of the automotive sector, with the example of Volkswagen, you can see here how we approach that. And you might be also, and we put in here Volkswagen as an example, because you might be aware that if you would look at Volkswagen from an ESG score point of view, you would just say it's not investable for a sustainable investor, because the ratings are very poor. They're still down. We still have these diesel court cases going on in some countries. So this is never really improving. Yeah, but it's still very much back end loaded, and it's looking in the very, very past of this company. And this also clearly does not take into account that since then the company changed the entire management and also the supervisory board, etc., etc. So what we do here now with our approach, as you can see, for the automotive sector, we have 3 dimensions. We're looking at the strategy, we're looking at the investment, and we're looking at the governance. And just to give you an example on this specific company, we look here on the strategy on what are their CO2 emission reduction targets and their ambitions. And what we like here very much is, first of all, they are looking on all scopes, and very important, they have a very, very high ambitions for their suppliers. So they are tracking them. They're making sure that when we speak about electromobility, that they're taking care about their materials in terms of metals, that they are sourced in a way that is meeting all human rights issues. Then secondly, when they're going for smelting material and when they're purchasing the battery material, they demand from their supplier that they do not produce the batteries with coal. Because clearly, if you drive an electric car, which has a battery included, which was produced with coal energy in China, then the, let's say, life cycle is not very positive when it comes to CO2 emission. And clearly, this car might have a 0 tailpipe emission, but if you look at the entire product, it is at some point even more negative than an internal combustion engine, depending on the size of the battery. So that's something where we look at, and there the company is really on the forefront and is reducing that. Then we like very much also there when we're looking at the investment, they do have one of the most ambitious and highest capex plan in the market, and also their investments in R&D is the largest one in the entire sector in total amounts, but also relatively when you look at it in relation to sales. And then also we look at their joint venture system. So what are their strategic joint ventures? Because you can't really finance everything yourself. It's too much transformation going on. And this is also for us in this company very positive. So they are very comprehensively, and they have a lot of strategic joint ventures in the areas of software and also metal. So they're doing a lot of things. And what we also like here very much is their joint venture they have in the Scandies with Northvolt, which will be one of the battery producer in the future with the lowest CO2 footprint. And that is something which we also take here as plus points into our valuation. And then when it comes to governance, we look not only if there is an ESG linked remuneration system in place for the board, because that's for most European companies anyway. We also look what are the KPIs. So what exactly is this management board be incentivized for? Is there a hard KPI? Is there a number, like in case of Volkswagen, a number of electro vehicles per market they have to achieve? Because only if you incentivize the management accordingly, the targets will be met. This is what we look at. It's a qualitative approach. And then we also look on what they do on the diversity side in their management board levels. And that's also where the companies score pretty well. So on the next slide, which is also then my last slide as a little summary, we believe that the carbon footprints will become more attention in the future in our portfolios, but also clearly then in the real world. That therefore, we also believe that these backward-looking ESG data and ratings will shrink in their importance, so they will not be the main investment driver in the future. That's why we very much want to invest in transformation candidates. So thinking here also about a positive impact thing. So we want to have here really the ESG improvers. We don't want to sit on the green high valued darlings in sustainability. We want really to finance the delta, so the improvements of companies. Then we also clearly want to use intelligence learning and artificial learning machines to get a better grip on their decarbonization targets, strategy and pathways, so that we can really tell them, okay, you are proceeding very well, or Houston, we get a problem. So that is also something where we need more data, more information, and clearly with a focus on the future. So not what happened in the past, but what's going on in the future. Also to measure what's going on in mergers and acquisition. That is also an element, because what we don't want is that our companies are just selling off the stranded assets and the carbon intensive assets, and then they're out in a way which we can't measure anymore. So that's why we also want to have here pathways and to get a better grip what the companies are doing here. So that's in essence our approach. Is we believe you do need a combination of ESG research and fundamental research. So that's why we combine that. And we also believe you have to be an active manager, because otherwise you will just follow a data impulse or just follow the mass. And what you need is you really to identify the improvers and the ones which are more promising in the future and yielding better future strategy, but also returns, not only in a financial way, but also in a CO2 footprint way. And that's, in summary, our approach we take here. And these are just, as I mentioned, two solutions where we work on which we use. There are clearly more and also more in the pipeline, but that is just an idea I want to give for today, how you can tackle it or how we are going to tackle this. And with that, I would like to go back to the podium, and I really hope, even if you can't see me, that you might have questions for me.
Thank you, Katia. So is there any question?
Thanks, Katja, for that. My name is Claudia Hita. I'm at the Luxembourg Institute of Science and Technology. So I'm really interested in the carbon footprint you've measured for these portfolios. I wanted to ask about to what extent you're able to include scope 3 emissions, and then also to what extent you are aware whether companies in their scope 2 emissions are using renewable energy certificates or not. Thanks.
Yeah, question number one, scope 3 is not yet possible. I mean, we do have it in the system. So if you want, we have two systems. Yeah? So we have one with just scope 1 and 2, and then we have the other one who's trying to train herself. She's called Malina, with scope 3 as well. But there I can share with you, this is really not useful for the time being. So to give you an example, we had one major cable company who's producing cable, but also LED lightnings. And this company suddenly came up with their new scope 3 calculation for LED lights, which were running in their calculation 80 years. And therefore this scope 3 suddenly was, I don't know, I think 3 times of that of BASF, and the whole system was kind of warning. And this was clearly not working for us, because then the sector shows it was an extreme event. And then we came to the conclusion, okay, it's good to have that, to learn from it, but now you can't manage portfolios according to such signals. That's not possible. So in essence, we do not have it yet in our portfolio, let's say, system and how we steer it. But there is a second Malina with scope 3, and this system tries to learn as well and to include scope 3s, but it's for the most sectors not working. And even when you then be in an individual sector, then one company pops out like this and the whole system is not working anymore. So that is here the major problem. That's to this question. And yes, on the scope 2, we do have, this is including the carbon offsets and the certificates buying when it is reported by the companies. Then we include that, and then we highlight that. We do not yet deduct it, but we highlight the element of how much then is dependent on these offsetting. However, I also can share with you that many companies do not single them out. So it's not common, even not for European companies. They just generally say we do use carbon offsets, but they don't give you the quantity. And then also our system can't exclude them in the calculation.
Me again, follow up.
Yeah.
To what extent do you think that what you have built now, so you think that this will be very helpful in the future when you're making investments? To what extent are you able to take an advantage from that, or are you able to better signal? So is this the kind of data that the industry will be moving towards, or are you the outlier that has this for now?
Actually, we hope that the industry is moving for this direction, because that is, in our view, the only way of really being able to address your investments in the right companies and also to steer your engagements. Because when you go for many engagements, when it gets to climate, it's kind of 1.5, 2 years backwards with the data. So and then very often when you speak to companies, they tell you, yeah, we solved this already. Oh no, that's already gone. No, we tackled that. So it's very inefficient. But with such an element, you can really discuss with them and their treasury department. Okay, guys, what is your calculation? According to ours, X, Y, Z, you can't meet your climate ambitions. So if you say you can you outline where we are wrong? So you have a complete different, let's say, kind of engagement and quality of discussions with the companies. And we believe you learn much more from this and from their thinking than if you just look on the, let's say, CDP data of 2020 for the moment. Yeah? And that's where we believe you will have hopefully alpha and you learn more and you'll be able on investing the right companies compared to the others. And also when it comes, like your question before, it also increases our knowledge on these carbon offsetting strategies of many companies. And that will be a challenge for many companies because so far they were relying a lot on this. And if they get now more questions from us, from you, from the rest of the investors, then clearly, hopefully, they won't go for this easy way of reporting lower CO2 emissions every year, because then they really have to deliver something from the operations.
Any more questions? Thank you, Katja. Any more questions? So I would like to thank our excellent speaker and for Union Investment for hosting the sessions. So our next session will start at 11 and it's hosted by T. Rowe Price and focusing on the importance of ESG in value investing.